All right, so in this video, I'm going to talk about calculating the periodic operating cash flows associated with the capital budgeting project. So when you're calculating the periodic cash flows, basically what you're looking for is the changes in cash flows that are arising as a result of the project. So as a general process, basically what you're going to look at is whatever change in sales is being produced by the project or changes in revenues, minus whatever changes in costs, minus whatever changes in depreciation. You take that whole amount and you multiply it times 1 minus the tax rate. So you find essentially the amount after tax. Then you add back that change in depreciation. All right. So if we look at that, there are a few points to kind of consider here. So first, we're trying to get to cash flow, right? And depreciation is not a cash flow. So you might be thinking, well, why are we bothering with depreciation if it's not a cash flow? Because I subtract it here and then I add it back over here. So why bother? The reason why I bother is I subtract it over here because that affects my pre-tax figure, which therefore affects my taxes, which is a cash flow. So the only reason we're messing around with depreciation is basically because it affects what we're going to do in terms of taxes, what we're going to pay in terms of taxes, and that's a cash flow. But once I've figured out what the impact is for tax purposes and what I'm going to have left over after taxes, I add it back in because it was never a cash expense to begin with. Now, having said that, we also need to be careful about cost savings. So I have a subtraction here for subtracting this change in costs. So in other words, if costs go up, I would subtract off that increase in costs and reflect the fact that this machinery has an outflow that's associated with those costs. However, when you're doing this, do make sure you're being careful about the signs of what you're doing, particularly if you have cost savings. So if a piece of equipment is expected to save you, say, $1 million in costs a year, if that's the case, you need to make sure that you're showing it as a positive impact here due to the fact that it is a cost savings. So you basically have to pay attention to the signs you're using when doing these kinds of calculations. And ultimately, I'll show in a subsequent video in Excel basically how you could line this out and basically kind of present it line by line to show the different cash flows and ultimately get to your operating cash flow per year. And basically, as long as you're careful with your signs, there's actually more than one way that you could do the math. In other words, I could have a negative number and then I just add everything, or I could do a formula in Excel where I take this number minus this other number. And so, there's multiple ways you could create the correct overall result. You just have to be careful how you are doing it to make sure that you are creating the correct result and that the cash outflows are showing up as negatives, the cash inflows are showing up as positives. And really, if you kind of step back for a moment and you think about kind of what we're doing here, this is very similar to the idea of looking at cash flow from the standpoint of NOPAT plus depreciation. So NOPAT was our net operating profit after tax plus the depreciation. And that's kind of what we're doing here. That's the basic sense that we have here. Only to the extent that I'm looking at a specific project, it wouldn't necessarily be a full-on like net operating profit kind of calculation, but it's the at least not for the entire company, but it's that idea basically. Now, something else that I mentioned here a moment ago kind of requires that I revisit it. And that is, I noted that we're the only reason we're looking at depreciation is because of tax purposes. So let's talk about that a little bit more detail. Most companies in the United States actually have two different sets of books. And this doesn't mean they're doing anything fraudulent. What they're going to have is they're going to have one set of books that's following generally accepted accounting principles, and that's going to be the set of books that they're going to use to generate their financial statements, their income statement, their balance sheet, cash flow statements, all of that, right? And on those books, generally what they're going to do is they're going to try to depreciate the assets in a way that more or less matches their estimation of the asset's value. And if you go way back to accounting, there's kind of an accounting matching principle there where we're trying to match the form of depreciation with how the value of the asset is actually changing. And so we're trying to show the true value of the asset on the financial statements. That's the basic idea behind that. And we're going to still be doing that over there on those generally accepted accounting principle-based books. However, companies are also going to have a second set of books. And that second set of books is basically the books they need to have for essentially tax purposes. Because for tax purposes, all kinds of things are different. So the government, the federal government has all kinds of rules about what constitutes taxable income, what doesn't constitute taxable income, et cetera. And so as a result of that, when we're evaluating a capital budgeting project, basically one of the things that we have to look at is we have to be looking at depreciation methods for tax purposes, because the only reason we are looking at depreciation in this context is because it has an impact on taxes. So basically what we're going to be focusing on is what form of depreciation would be used for taxes. And that brings up sort of a follow-on discussion that's important to have. So since this is not our generally accepted accounting principles books, over there on our generally accepted accounting principles books, we're going to try to match the lifespan of the asset and everything else. So we're still trying to do that. But over here for tax purposes, that raises an interesting question. For tax purposes, how would I want to depreciate an asset? And the answer is I would want to depreciate that asset as fast as they will let me, pretty much. And here's why. When I show amount of depreciation for tax purposes, that reduces my taxable income, and therefore I don't send as much money to the federal government. Now, to the extent that that's the case, something that's important to note here is the sooner I can depreciate it, the sooner I save money in taxes. So here's the question. Do I want to save $1 in taxes now, or do I want to save $1 in taxes in, say, 5 years? And if you're thinking, well, I'd prefer to save $1 in taxes today as opposed to $1 of taxes in 10 years, congratulations, you're thinking about time value money correctly. That's absolutely right. I'd rather save $1 of taxes now. So if that's the case, basically, as far as tax purposes are concerned, we pretty much want to depreciate that asset as fast as the government will let me. So that brings up an important point. And that is basically the form of depreciation that will probably make a lot of sense for us to use in this context is the Modified Accelerated Cost Recovery System depreciation. And that's a mouthful. MACRS is the acronym. So Modified Accelerated Cost Recovery System. And basically what it is it is a form of depreciation that applies for tax purposes. And that, because it is a form of depreciation that applies for tax purposes, that's probably the form of depreciation you'd want to use in many cases in reality when performing a cash flow analysis for capital budgeting analyses. Now, how exactly does the MACRS depreciation work? It's actually relatively simple. So basically where you start is you look at the asset you have and you determine the expected lifespan of the asset. So let's suppose I have an asset, I expect it to last for 3 years. All right, so if it's going to last for 3 years, I can actually look up in various resources and find a table with MACRS depreciation rates for a 3-year asset. And basically what I'm going to find is for year one, there's going to be a percentage there. And I'm going to take that initial depreciable basis that I talked about in a prior video. I'm going to take that total initial depreciable basis. I'm going to multiply it times that percentage for the first year that I find in that table for a 3-year asset. And there's my depreciation expense figure for the first year. And then I'm going to take that a whole depreciable basis, and I'm going to multiply it times the percentage I find for the second year. And that's going to be my depreciation expense for the second year. And then I'm going to take my depreciable basis, and I'm going to look in the table. I'm going to find the percentage for the third year, and I'm going to multiply those together, and that's going to give me my total depreciation expense for the third year. And so basically, to use this is actually pretty simple. I just have to find the table, get the percentage, apply that percentage to my total depreciable basis. There's my depreciation expense for the year. Nice and straightforward for the most part. There is a little wrinkle. So here's the wrinkle. The wrinkle is if I was looking at the table for a 3-year asset, you would think if it's a 3-year asset that there would only be 3 depreciation rates, one for year 1, one for year 2, one for year 3, right? That makes sense. Well, there's actually going to be 4. And if you're thinking, well, why on earth are there 4 for a 3-year asset? Well, the reason why there are 4, there is a logic to this. The reason why there are 4 is because the assumption is, from the standpoint of the government, that even though it's a 3-year asset, you probably didn't buy it on day 1 of the tax year. So if it's a 3-year asset, it lasts for 3 calendar years, but you didn't start at the very beginning of a tax year. So that means it's going to actually kind of spread its lifespan over 4 tax years, most likely. And so hence there are actually 4 depreciation rates. But the process is still as simple. For depreciation for the first year, you find the number, multiply times that depreciable basis, and there's your depreciation expense for year 1. You do the same thing for year 2 and for year 3, and there you go. Now, if it's a 5-year asset, you look at the table for 5-year assets. If it's a 7-year asset, you look at the table for 7-year assets, and so forth. So it's actually relatively straightforward. Now, once you've found the depreciation expense figure, you're going to factor it into your change in cash flow calculation. That's going to affect your taxes. but then you have to add that number back before you're done finding your operating cash flow for the period. Now, it's also worth noting that it's possible that a project could trigger an ongoing change in net working capital. So if there is an ongoing change year after year in net working capital, then you would need to factor that into. And again, an increase in net working capital would be an outflow, and a decrease in net working capital would be considered an inflow. Now, the real challenge associated with a capital budgeting analysis comes down to actually figuring out what the incremental sales, cost, depreciation, et cetera, are. That is actually the hard part. Because if I am looking at a business and I'm thinking about buying a piece of machinery and installing it in my factory, then the question is, well, what cash flows change? And the answer is there is no magic list to this. We're just going to have to go out there and figure it out. So that's basically going to mean we're going to have to look at, all right, what does this do to my energy bill? What does this do to my insurance bill? What does this do to my my maintenance bill? What does this do to the number of hours I need to have for my employees? Now, I basically just need to come up with everything I can think of that is going to be affected by this choice and figure out what those incremental effects are. And that's where I'm going to get the numbers that I'm going to then put into my analysis to get to this overall change in cash flow. So that's actually really the hardest part of a capital budgeting analysis. Calculating net present value, IRR, MIRR. I mean, there are functions for that in Excel. It's relatively straightforward. That's actually really not that bad. Really, you should kind of expect to get those calculations right every time. The hard part is figuring out what on earth are the cash flows that I use to overall figure out my operating cash flows and things like that I could then use in those calculations. So the cash flow estimation part is really the hard part of the capital budgeting analysis. It's also something that is really difficult to replicate in a purely classroom environment, because unless you actually have a project sitting right there that then you can dig into and figure out what exactly does this thing do to the cash flows, it's difficult to really get that full experience. So from that perspective, if you happen to wind up evaluating projects down the road, that's the hard part, figuring out what does this thing do to the cash flows. All right, hopefully this video has been helpful. Thank you so much for watching and have a great day.